I am Jacob. If the U.S. financial markets are compared to the active volcano in Yellowstone National Park, then the current U.S. debt ceiling problem is the volcano's eruption point. The U.S. economy is approaching the tipping point of recession, is likely to breed another financial tsunami. The scale is close to the subprime mortgage crisis in 2008. When the U.S. reached the $31.4 trillion debt ceiling on January 19, Treasury Secretary Janet Yellen immediately announced that the Treasury Department would take extraordinary measures to prevent a default on U.S. debt. But the issue of raising the debt ceiling is still hotly debated in the U.S. Congress. Since 1960, the debt limit has been raised nearly 80 times and more than 20 times since 2000. Although the market currently believes that this crisis will be like the previous one and will eventually pass. But major Wall Street investment banks, including Goldman Sachs, Bank of America and J.P. Morgan Chase, have warned that the U.S. is now in the most dangerous debt ceiling quagmire since August 2011. J.P. Morgan Chase released a report on January 28 saying that the debt ceiling fight could be the most important issue facing the U.S. economy and U.S. national debt in 2023. This is because since the last U.S. subprime crisis, the U.S. financial system has become more and more dependent on debt. This time, the U.S. has more debt, higher interest rates, and a more divided Congress. The market may have seriously underestimated the risk of this U.S. debt limit crisis. In the immediate aftermath, Janet Yellen of the U.S. Treasury Department said on January 29 that the U.S. debt default made her nervous and warned, "If Congress does not raise the debt ceiling this summer, the United States will face a catastrophic debt crisis that will lead to a spiraling recession. If there is a default, we will face a financial crisis." Yellen went on to say, if extraordinary measures are exhausted in early June, the U.S. could default on its debt, which could have serious consequences before the day the U.S. debt is liquidated. And this potential default will be a disaster for the U.S. national debt, a self-inflicted disaster and a very irresponsible approach. We note that Yellen's stern warning on January 14 revealed the risk of an imminent first U.S. default. After the debt ceiling was fully breached, she issued two kinds of warnings. One is a warning about how close the U.S. is to an actual default. The second was how catastrophic a default would be for the U.S. economy and financial markets. But analysis suggests there is little Yellen can do to prevent a U.S. default. In her January 28 letter to Congress, she was careful to say that failure of Congress to reach consensus could accelerate a liquidity collapse in U.S. Treasury trading. This will become even more certain in anticipation of the Fed's monetary tightening initiatives, because as a consequence of the Fed's continued rate hikes, the strong dollar cycle will eventually backfire on the U.S. debt market and become the nuclear bomb that triggers the U.S. debt crisis. Such an outcome will lead to a rise in interest rates on newly issued U.S. Treasuries, accelerating the withdrawal of investors from the Treasury market. At that point, if the U.S. Treasury wants to roll over maturing debt, it may have difficulty finding buyers. At that point, the U.S. Treasury will put pressure on the Federal Reserve to repurchase Treasuries in the secondary market, and this behavior is essentially quantitative easing. This is exactly the same reason why the Bank of England was forced to buy UK government bonds in August 2022. But such an outcome is likely to lead to another rapid rise in U.S. inflation, superimposed on expectations of a U.S. recession, which will likely push the U.S. economy into stagflation and put more selling pressure on the Treasury market. On January 18, the U.S. Treasury released the Treasury International Capital Flows Report. The report showed that global official institutions sold U.S. debt on a net basis for the 10th month in a row. And since the Fed raised interest rates last year through November 2022, they have sold a net $736.9 billion of U.S. debt. Since 2020, global central banks have even accelerated their shift from being the largest buyers of U.S. debt to the largest net sellers. For example, Japan, the largest holder of U.S. debt, has sold a net $240 billion of U.S. debt during this period, the largest selling effort among global central banks. China, the second largest holder of U.S. debt after Japan, has held U.S. debt below the $1 trillion mark for 7 consecutive months. As of November last year, the position had fallen to a 12-year low of $87 billion. Analysis shows that Japan's position in U.S. debt is now getting closer to falling below $1 trillion. This is because, for the second time in a row, the Bank of Japan has lost control of its new JGB yield ceiling target in the past 2 weeks, announcing that it will maintain it for several weeks from January 16th in order to make additional JGB purchases. Looking at past data, it appears that the funds needed for the BOJ to purchase JGBs will have to be replaced by a significant sale of U.S. debt. This comes at a time when Japan has been experiencing high inflationary pressures for decades, and there is a possibility of a shift to ultra-loose policy tightening. This will become one of the biggest tail risks and black swan events facing U.S. Treasuries, and one of the nuclear bombs that will detonate the U.S. debt crisis. U.S. financial website Zero Hedge analyzed in a follow-up report on January 28 that Japan, the largest U.S. debtor, is not ruling out the possibility of reducing its U.S. debt position to 10% of the current total as a deterrent to the dollar. This suggests that Japan will continue to liquidate U.S. Treasuries as long as the Federal Reserve does not stop raising interest rates. Japan, the biggest black swan of U.S. debt, is contributing to the historic U.S. debt collapse and the imminent first U.S. debt default. The yen hit a new low in more than 3 decades. The Bank of Japan in the past 3 months in 3 sudden sales of U.S. Treasuries, reflecting the action, dumping U.S. debt to become the largest foreign debtors of the United States routine operation. As of November last year, Japan's position in U.S. Treasuries has fallen sharply to the lowest level in 3 years to $1.0822 trillion. It's the end of this video. Thank you for watching. Please subscribe to support me. See you next time.